You're listening to Withum's Taxing Topics. When it rains, it pours. Tax regulations and guidance are dynamic, continually changing domestic and international financial waters. Step under Withum's umbrella to better weather the storms of trending taxing topics. We'll share the essential news and information you need to prepare for what's ahead.
Hello, everyone. We're welcome for you to join our second podcast in Withum's podcast series monitoring the election and potential federal tax reform. We had a great first conversation with the Congressional Budget Office Director to look at that 10,000-foot view as to why tax revenue matters, right, for the federal government. And today we're really excited to talk about the 2024 election outlook, as well as federal tax reform that introduce federal tax reform policies that both the Democrat and Republicans seem to be supporting. So as background, today is July 31st. We did have quite a shakeup in the Democratic presidential election, in the fact that President Biden has dropped out. And now we have we're assuming Kamala Harris to step in as the presidential running person for the Democratic Party. And I will caveat this and saying that when we go through and talk about the Democratic policy, it really is not going to be based on any policy that has been issued as of this time, but instead is based on how Vice President Kamala Harris has reacted towards tax reform and policy in her 2020 election and her Senate election. So I'm very excited to introduce you to our attendee today, who's going to help us walk through all these questions. His name is Brian Reardon. He lives in DC, and he's very close to a variety of different leaders and groups in DC that really helps us understand what's happening on the ground floor, which is obviously all located in DC. So I want to introduce Brian Reardon. He is the president of the S Corporation Association, and we're going to allow him to give a little explanation of what he does in DC. So, Brian, thanks for joining us today.
Sure. Thanks, Lynn, and thanks for having me on the show. Thanks for all your advocacy, too, because I don't know if the listeners know, but Lynn is a tremendous advocate for private companies here in DC and nationally. And you guys are lucky to have her. We're lucky to have her as an advisor to the S Corp Association as well. I'm an advocate, a lobbyist. I run the S Corp Association. I also work with a trade association that represents single-family offices. So really my wheelhouse are larger, closely held family-owned businesses. And the challenge there is that when people start talking about tax policy, usually the people who are the experts, the people who are writing the bills, they tend to come from the corporate world, which is good. Corporations are great, but for all those companies that are organized as S Corps or partnerships or LLCs, it's a different set of rules. And so our job, as I see it, is to make sure that the family business sector, the pass-through business sector, is well represented up in DC. We've got the two trade associations, also have a coalition of Main Street business trade groups. So this is the Farm Bureau and NFIB, the roofers, all the folks that you would think if you're driving down Main Street, you would see their businesses. Those are the trades that are part of our organization. And, we're up on the Hill every day trying to make sure that people understand the differences between pass-throughs and corporations and how you can treat pass-throughs fairly. And then sometimes we have to go and oppose things as well.
Yeah, that's a great point, Brian. I'd like to, something I don't think everybody always realizes, I certainly didn't when my first introduction to congressional leaders, is that they have a variety of topics they need to be, aware of, and they are masters of none, right? I shouldn't say none, but limited amounts. And so it is exactly a big portion of advocacy for private businesses and family businesses is explaining the tax laws and how they really apply. Do you assuming that your congressional leader understands? I wouldn't say today. I think it's becoming more relevant, but 2 years ago, what a 199A deduction is probably incorrect. So really making sure that you're working to explain not only the technical law, which is where Brian comes in, myself and others, but also what I find more an advocacy for our clients is explaining what, if the tax law changes, the impact is going to be to their company, to their employment, to their community, to their growth. That's something that really resonates with our congressional leaders. And that's why it's so important, which we'll talk about more towards the end of, I know many of our clients wear multiple hats, and the last hat they want to do is put an additional hat on to advocate for their company. But as we go through today's podcast, I hope you all hear the significant changes that could occur and understand a little bit more about that there isn't necessarily anyone else out there besides these certain groups like the S Corporation or the American Council of Engineering, et cetera, Main Street USA, that are advocating for this space or this business type. So without any further ado, we're sitting here in July. We've had some major shakeups happen in the political election in November. And so I just wanted to get Brian's thoughts about, the end of July, beginning August. Obviously, if you're listening to this in September, October, it could have changed. But essentially the current state of the November elections. What do you see happening with the presidential election, which oftentimes can overshadow the real opportunity we're going to have to do tax reform, because there also is major elections happening in the Senate and the House, and what that vibe is happening and what that vibe is being explained as in DC. So I'd like to listen to a little bit of Brian explain to us how the outlook for the 2024 elections are shaping up.
Well, it's the $64,000 question. We're 3 months out. It very much is an open question: who is going to control Congress, who's going to run the Senate, who's going to run the House, and who's going to run the White House. It's all very close. I think the one area where we have a little certainty, or maybe a little more assurance, is in the Senate. It does look like, unless something dramatic happens, Republicans should retake the Senate. Right now, they're sitting on right about 50 members. I think the Democrats are at 43, and there are 7 toss-ups, all of which are Democrat seats. So the Democrats effectively would have to run the table on all the competitive seats out there just to get to 50-50. And I think there's a couple states, particularly Montana and Ohio, where it looks like the Republican challengers are doing very, very well. And so I think there's an expectation that Republicans will take the Senate. The House.
Brian, let me stop you there. And I think it's important to highlight then, for those of you who are listening, maybe don't know, the Senate Finance Committee is a significant piece of the committee or process in federal tax reform. So what would that mean to the leadership of the Senate Finance Committee?
Well, so yeah, we can get into that when we get into the policies, but if Republicans are in the majority, then they're the ones that get to appoint the chairs to all the committees, like finance or banking or all the rest. And that would mean that Mike Crapo from Idaho would be the chairman of the Finance Committee, and Ron Wyden, who right now is the chair, would become the ranking member, and obviously the chair gets to dictate the agenda and which bills are going to be considered, and presumably he's got the votes to pass them, so that'll mean that Republican policies get enacted as opposed to Democrat. In the Senate, it's always a little fuzzy because you do have one, particularly if you have thin majorities, you often have swing votes, like we saw Sinema and Manchin back 2 years ago when the Democrats controlled everything. Ended up blocking a big part of the Biden administration's proposals, and we frankly helped them. We weren't fans of the Build Back Better Act. Anyway, and so you do have to work across the aisle to a certain degree. Usually, the Senate is much more. The rules are just set up so that they sort of push you into being much more compromising with the minority than they do in the House. So the bottom line, though, is that if Republicans take the Senate and they take the House, which is very much an open question, it's very much more in play. Then they'll be in a position where they can write their own budget. They can put in what's called reconciliation rules, which help them to pass things with simple majority votes. And they'll be much more in the driver's seat in terms of what gets presented to the president in terms of tax policy. Are we going to extend some of these TCJA provisions, all that?
Perfect. And tell me a little bit about the House race. So you said that one's much more up in the air. Are there any particular states that you think are going to be monitored closely throughout the election process, or that are going to be a big focus for the Democrat and Republican parties?
Yeah, the House is a bit of a mess. I mean, the Senate, it looks much more mature, and the House, they have very tight majorities there. There's 435 members, and I think right now the majority is maybe 3 votes for the Republicans. It's very, very tight. Plus, even though there are 435 seats and everybody is up for re-election, there's really only about 30 or so competitive seats. So, you've got a lot of guys who are just going to get reelected, very few number of competitive seats. Those are very close, as you can imagine. And really, I think most people, and I tend to agree with them, think, well, if the Vice President Kamala Harris wins, then she'll probably have the momentum, and that momentum will leak over into the House, and the Democrats will control the House. If Trump wins, same drill, that he'll have the momentum, and those races will go towards the Republicans. Either way it goes, they're not going to have big majorities. I mean, if either one has a double-digit lead in terms of the votes, I would be surprised. So, again, kind of like with the Senate, where compromise is usually something that's baked into the cake. If you're working in the House and you've only got a 5-seat majority, as we've seen with the Republicans for the last 2 years, it's really, really hard to get things through. And in must-pass situations, you do have to work across the aisle and come up with some provisions that everybody can agree to.
Yeah, it's a great point. I think it's interesting you say that, and I think it's true. The Senate has traditionally shown more appetite to work across the aisle, and the House sometimes it can be more challenging, especially with a limited majority. Most of our listeners, or a predominant location in which Witham operates, includes California, New York, and New Jersey. And I would point out that toss-up House races include 5 representatives out of California and 3 out of New York. So definitely something to be aware of and keep your mind on. The only toss-up kind of that's been highlighted in New Jersey is Tom Keene. So there's the stage, and I think you've said it pretty well. And I think that's a great point to say, whatever president is ultimately elected, that's probably where the House is going to go. So you could say or project, again, all hypothesis, that if President Trump wins the presidential election, we could potentially have a Republican sweep of the House, the Senate, and the presidency. And then alternatively, we could have a split Congress, meaning the House could go Democrat, the Senate could go Republican, and then the president nominated could be Democrat as well. What do you think that does, or how does that influence tax reform that could or could not be seen in the next year or so?
Sure. Yeah. So one of the old hits on Congress was, that there's not really a dime's worth of difference between the two parties in terms of how they actually behave. That's not really the case these days. There's not just a dime, there's trillions of dollars worth of difference between the two parties. So I think the potential policy outcomes, depending on the election outcome, are really dramatically different. If Democrats, for instance, let's start with that. If Democrats sweep, so that you have President Harris and then Democrats running the House and the Senate, a lot of people are trying to get a sense of where she's at in terms of tax policy and all that. I think the general perception is that she's definitely to the left of where President Biden is. Mm-hmm. And so, based on that, you think, okay, well, she'll be pushing more progressive tax policies. I'm not sure that's the case, just because, well, 2 things. One, Biden might be personally viewed as a relatively moderate person, but his administration, particularly in tax policy, has not been moderate at all. As I said, we spent 2 years fighting the Build Back Better Act, and that was a very, very aggressive set of tax policies, literally trillions of dollars of tax hikes that would have largely been imposed on family businesses, wealthier individuals, some corporate tax increases as well. But to give you an idea, they were going to increase the cap gains tax up to 40%. They were going to apply cap gains at death. They had a couple surtaxes in there. So if you're a high income person and you make more than, say, $10 million, I think the surtax was 5% on top of the taxes you're already paying. If you made more than 25 million, it was going to be 8 percentage points on top of the taxes you're already paying. You're still going to have to do the estate tax, and they had a bunch of rules to increase the bite of the estate tax, but also limit the planning that families are able to do in order to, have their business succeed from one generation to the next. So it really was kind of, from my perspective, just very much an all-out assault on kind of the family business structure and the ability of family businesses, not just to survive one generation, but from one generation to the next. And we really had our back against the wall. So getting back to the question, I really think my expectation would be you would just see a continuance of that you would see another reprise or something similar to the Build Back Better Act introduced, announced by the president. Big difference would be this time around, you won't have Sinema and you won't have Manchin in the Senate to defend family businesses. As a result, I think that there would be a very strong chance that policies like that would get enacted and that you would see, significant increases in rates on a broader base and create a very difficult environment for businesses to survive and to be profitable.
Yeah, I totally agree. Again, we don't know the policy that potentially will come out. I have heard rumblings that, the campaign for President-elect Kamala Harris might back away from that $400,000. Everybody above that pays more, everyone below that pays less. But there's also other significant changes, that weren't necessarily included in Biden's proposal, which was, no longer should there be a capital gains rate for anyone, essentially,
Right.
but that it should, essentially be taxed at ordinary income tax rates. So, definitely, something to monitor, I think. And to your point, I always like to share the story, and I can share the story because I was able to work with Brian through the S Corporation. But we were in DC a couple years ago talking to both Republicans and Democrats on 199A. And for me at the time, I thought it was a no-brainer, right? When you think about the background of why we have 199A, to have parity with C corporations, and C corporations have a permanent 21% rate. I just didn't have it in my head that at any point in time they would get rid of 20% deduction, again, only for certain entity types or businesses, because it, puts them more in line with the 21% rate, not exactly, but down to closer to 30%. And I honestly, when I went to DC, was not expecting to hear rejection of that. But more and more so, for those of you who maybe aren't as involved in monitoring DC, it is definitely an issue that I don't think many people know is drastically on the table, right? And I know that's a big advocacy area for private and family-owned businesses, but also for Brian as well. And some people are even calling it a tax loophole, or giving wealth to the rich. And so I think there's a lot of education in that area that's going to have to be engaged with. And so I would agree with the sentiment that we tend to see more Democrats right now than Republicans have a voice in saying 199A should potentially be eliminated. So that's something that would significantly help discount or make it challenging for private and family-owned businesses, on top of the estate tax, which, to be honest, nobody likes to think about the estate planning. But indeed, to the extent you can't transfer your company, to the next generation without incurring some tax, that's very challenging as well. And we see that oftentimes, talked about with farmers in the West and the Midwest. And that, if they have to pay tax in the time in which they transferred their land upon death, they would have to essentially sell some of their land. It's not necessarily cash that they have to pay out, right? They're owning, it's part of their business. So how that would potentially impact family and private owned businesses is yet to be seen, and hopefully won't be seen. But all great points.
Yeah, we'll see. So yeah, like my chairman says, for a family business, every generation you got to buy back a certain percentage of it from the federal government through the estate tax, right?
Yeah.
So really hard. So I think that with the Democrats, running things right now, that seems to be the least likely scenario. Maybe 15-20% likelihood that happens. I think the other two potential outcomes are evenly divided, and that is Republicans control everything, probably about a 40% chance. And then, as you said, the divided government where Republicans have the Senate and maybe the Democrats run the House and the White House. That's probably another 40%. And it really does, again, if Democrats run everything, then I would expect, massive amount of pressure on rates to go up, cap gains, tighter estate tax rules, significant tax hikes across the board. I do think Kamala did say that she is going to continue with the not raise taxes for people under $400,000. I think she did say that. So, I would expect that policy to continue to be part of what they look at. But as we all know, that's really hard to do. I mean, it's really hard to have sort of a general tax hike, program and protect, everybody making less than 400,000. Plus, if you're really trying to raise lots of revenue the way they are, it's hard to get a lot of revenue out of if you're limiting, the tax hikes to just the top 2-3% of wage earners, right, or income earners. So anyway, the big challenge, as you mentioned, next year is the TCJA. Is the provisions expire at the end of 2025. I think that, in terms of if Republicans run things, I would fully expect them to move very quickly early next year to try to move a package of both spending and tax policies that would extend most of those policies. They likely would include some additional provisions. I know there's an increasing amount of concern within the Republican conference with regard to debt and deficits. Mm-hmm. Our debt is getting to sort of record levels. Our deficits are getting in record territory. So something needs to happen on that front. So my expectation would be, one, they want to move fast, they want to be aggressive, and they want to extend most of the TCJA provisions. Exactly what those are is to be determined by the debate and all that. But that package would be tied to a package of spending cuts. And again,
so Brian, I think this really ties in nicely with our first podcast where we did talk about the ever-growing deficit. Yeah. We did talk about sooner rather than later we'll be spending more interest paying off our debtors than we will on defense. And we talked about our debt kind of alignment with the GDP percentage and how we're estimated to exceed what we did during our most recent highest peak during World War II. And so one of the conversations we had with Phil was saying, well, how much worse would it be if we had just extended all or made permanent all the TCJA? And it makes a worse picture, right? By what some may argue is a significant or not as significant amount. But what do you see if they say we're going to, or what do you anticipate? Obviously, we don't have a crystal ball, but if they want to ensure private and family-owned businesses still can get their 199A deduction, that there's some type of bonus depreciation, that interest expense limitation rules aren't so crass and not, necessarily touching a lot of the estate law, where is their revenue? Where do you think they're going to try to find the revenue that's needed to balance the budget?
Well, so to extend the whole package, if you just said, okay, we're just going to do everything on the TCJA, it's about $4.2 trillion, something like that. Mm-hmm. It's a big chunk of change. Right. And that's for, over 10 years. So it's spread out over a decade. Most of that revenue loss, frankly, is tied to the child tax credit, the lower rates for families, that make under $400,000, the increased standard deduction. So, there's a lot of rhetoric about how the TCJA was just a big tax cut for corporations and wealthy individuals. Actually, most of the revenue loss tied, most of the tax cuts went to families of modest means. So there is going to be a bipartisan support for extending those policies. And then it gets very dicey because, if you're talking about the 199A, the pass-through deduction, and state tax provisions and the lower rates for upper income individuals, suddenly that bipartisan consensus goes away. Mm-hmm. And that's where, if Republicans run things, they're going to, they're going to want to extend most of that. I doubt that they'll extend everything just as it is, but they're also going to want to have lots of offsets in there. And that's where, when Trump talks about his tariffs, there's this idea that maybe you could do some sort of border adjusted, what is it, energy tax, carbon tax.
Mhm.
Lots of new ideas coming in there. And then obviously, actually cutting spending, which I think would be a good thing to add to the mix. Um, that's where, I don't have a big enough crystal ball to figure out exactly how
Yeah.
all that works out, right? So, but I do think, when people think, oh, well, the TCJ, Republicans, they'll extend it, and Democrats, they'll just end the whole thing. That's not the way it's going to work out. There are good reasons within the TCJ for Democrats to want to at least extend a good portion of the TCJ provisions. There are other expiring provisions that they're going to want as well. So there are tax credits that benefit people buying healthcare on the exchanges, right? The Obamacare exchanges. Those expire at the end of next year, which would mean that, certainly a few million people would be in danger of losing their health insurance if those tax credits are not extended.
Which
So that's,
may be incentive for both parties to come to the table, right? Because obviously,
that's exactly it. Yeah.
yeah,
So it's not just like, oh, we're just talking about cap gains or 199A. No, we're talking about a broad swath of provisions that benefit both, high income people, low income people, individuals, families, businesses. And so there is going to be a mix of outcomes here, regardless of who's running things. I think the simple way to think about it is the more the Democrats are running things, then the pressure is going to be on higher rates and tighter estate tax rules. And if Republicans run things, then the bias is towards more extending the current policy with some very significant deviations from that. And those
yeah.
deviations are yet to be figured.
So, I mean, and previously, I've heard about that corporate tax rate, right? Something that wasn't on the list of the Tax Cut and Jobs Act because it was permanent. So it's not in that sunsetting provision. It's currently at 21%. It seems like the corporate community is saying we would even pay 25%, right? They know that their rate is really low. However, there seems, in the Democratic Party, they obviously are exploring all the way up to 28%. But I'm unclear on where the Republican Party is landing because it seemed as though there would be a slight rate increase, right? Maybe to that 25%. But President Trump recently came out and said he's going to look to even further reduce it from 21% to 20%.
Right.
What are you hearing in DC about the corporate tax rate and any potential changes?
I think all of those things that you listed out are possibilities. I think that the corporate sector, the folks who represent corporations, are not sitting back thinking, oh, we got to take next year off because, our provisions are permanent and Brian's provisions all expire. No, I think that everybody understands that, they are, when they address this, they're going to open up the whole tax code and everything will be on the table. And, it's certainly possible that the corporate rate goes up. I think from our perspective, the challenge is that, the whole idea of 199 is, if you have a corporate rate at 21% and a top individual rate at 37% right now, could be 39.6%, if we go over the cliff, then you need something to bridge the gap between what the S Corps pay, which is that 37%, and what the C Corps pay, which is 21%. That's what the 199 deduction does. It bridges the gap between the two entity types.
Right.
If the corporate rate goes up, then that gap gets a lot smaller. Some people would argue it goes away entirely. I don't know. And so it makes it, much more difficult for us to argue, oh, yeah, we need 199A. So, I think, at first blush, you think, okay, this is another case where it's going to be the pass-throughs versus the C Corps. I think we're all kind of in the same boat and hopefully rowing in the same direction on this. Certainly, we're getting lots of support from the chamber and some of the other groups that were very much on board with the corporate rate cut last time around. They're very supportive of extending 199. And I think they recognize, too, that if 199 goes away, then that puts upward pressure on the corporate rates. So
Great point.
Flip side of what my concern would be. So,
and I just want to stop there and because I know if there's tax geeks out there like I am, many of them might be saying, well, you're only talking about one level of corporate taxation and not the next level, right?
Yep.
Meaning when the shareholders get it. And usually there's only one tax assessed to S corporation shareholders at the end as it flows through, and then ideally not on distributions. So what I find, and I would love for you to speak about, is you really had a fascinating study that talked about that double taxation, meaning the corporation itself would pay 21%, and then the shareholders will pay another, potentially 23.8% on their dividends. But in reality, what did your study show, Brian?
Sure. Yeah. So what you're talking about is, and this is one of the challenges of particularly the TCJA, but it existed a little bit before that, but it was just magnified by the results of the TCJA, which is, there's just a huge variety of outcomes or potential outcomes with regard to business taxes, depending on how you're structured, what entity you've chosen, where you get your money, who your investors are, et cetera. So the way I think about it is, you start at a 21% rate for corporations. And if that corporation pays out all of its earnings to its shareholders as dividends in the year in which the corporation makes that money, and all of its shareholders are taxable individuals living here in the United States, then that double tax is significant, and it bumps the total effective marginal rate up to, right around 40%. Most corporations are like that. And certainly if you're talking about public corporations, what we find is that increasingly most of their shareholders are either tax exempt or they pay greatly deferred tax rates or reduced tax rates because they're qualified, retirement plans, they're foreign shareholders, lots of different things. So basically 3 out of 4 of public corporation shareholders are tax advantaged. They either pay no tax or they pay greatly reduced taxes, which reduces the bite of that second layer. And the study you're talking about, what we did was we asked our friends over at Ernst & Young, where does parity lie? I mean, where did we wind up? So if you take an average of all those shareholders that I'm just talking about and apply it to the C Corp world, you end up right around 30-31% effective rate. And then if you take the pass-through rate of 37% and subtract out the 199 deduction, and again, there are lots of nuances there. Not everybody gets the 199 deduction. And, even the people who get the one to qualify for it, they don't necessarily get the full deduction because there's lots of guardrails associated around how much of your income actually qualifies for it. So again, you take all those into account. Where do you end up? Well, you end up around 30 or 31%. So we've established rough parity. And the challenge is obviously it doesn't apply to everybody. And within those averages, there's lots of, ups and downs. But, close enough, right? And
Right.
so that's where we've kind of tried to convince our friends on the Hill that, it wasn't a pretty process going through the TCJA. There was lots of fighting going on. But at the end of the day, we kind of established, an equilibrium where family businesses can organize as an S Corp and they can compete with the big public C Corp down the street. And the reason this is important, because, the next question is always, well, why don't they just convert, right?
Every time I feel like
Every
that's
time.
the question.
And if you listen to my explanation of sort of the nuances of C Corp taxation, right? Well, the 21%, that's Berkshire Hathaway, right?
Mm-hmm.
It's a public company. They got lots of tax exempt shareholders. They don't pay dividends. Warren Buffett has never sold any stock. So their effective rate is down around, the low 20s. Whereas if you're a family business where all your shareholders pay tax, right? And you're closely held, so it's not like you can go on the stock exchange. You can't log on to Schwab and, sell you some shares when you need some money. There's no market for the, the shares of that closely held family business. Well, you're paying closer to 40% because you do have to kick out dividends and your shareholders do pay taxes. So the whole thing about, well, why can't they convert? Well, they can, but they're going to pay a higher rate regardless. And the real winners in this whole thing are the large publicly traded companies that have access to the public markets. Their cost of capital starts out lower. And then with the tax provisions, we're in danger of, adding a tax advantage to the cost of capital advantage. Well, that's why 199 is so critical because, again, it takes the family business that without 199, they're going to be paying rates just about twice the rate that Berkshire Hathaway is paying. That it gets them down into an area where they can be competitive and can be sustainable, frankly.
Absolutely well explained. So appreciate that. And that's part of the learning that's going on, I think, or the message that is trying to be highlighted for private and family-owned businesses. Going back to the tariff that former President Trump is proposing, what are you hearing? I have only heard that there's mixed reactions to that in the Republican Party. But I'm also wondering from an economic perspective, there seems to be some commentary that, if we up our baseline tariffs or up our tariffs on China, the opposite will occur as well, right? That they'll do the same. So costing, the average household more, not necessarily tax, right? But more costly products. So again, I am not an economist, so I can only read things. But what is your take on that, Brian?
I think he's very serious about it. I think the people around him are very serious about it. And I think we need to take it seriously. I'm totally conflicted on the idea of tariffs, et cetera. I worked in the Bush administration, and free trade, open trade policies, extending, an open door to our competitors and our trading partners. That was always kind of, that was the base case, right? And I think what we learned is that, it might be nice if you want cheap goods coming from China, in the retail stores, but there's an economic cost to that. And particularly with China, where, we spent years trying to highlight the fact that, not only are they dumping goods here, but they're also stealing our IP. I was involved, one of our members was involved in a FTC case where, they stole trade secrets and then built a plant based on those trade secrets to compete with the U.S. manufacturer. Fortunately, we won that case. But it's one of those things where, I think what Trump opened my eyes to is we really can and should be much more aggressive at looking out for our interests with regard to trade policy. I'm not sure that, just hiking up tariffs on everybody is, I think, what he's proposed to do, and significantly higher rates on Chinese products. I'm not sure that that's not going too far. And so, we're just going to have to see where all this goes. But I do think, he can do certain things administratively. I think regardless of whether he has a Republican or Democrat Congress to deal with, whatever he proposes is going to be, highly scrutinized and probably highly modified before anything actually gets enacted by Congress.
Right. And anything with negotiation, go in with your best case scenario and settle on something lower.
Yeah. So we'll see. One thing, I was engaged in the whole border adjusted tax thing back in 2015, 2016, partly just for selfish reasons that, implementing a border adjusted tax, I think it's good policy, but it also raises a lot of revenue. And we needed the revenue to make sure that the pass-throughs were treated fairly. So we worked on that. I think, it's possible that, the border adjusted tax issue comes back. And now that we've gone to this whole new GILTI regime in the territorial regime that was part of the TCJA, and we're confronted with the possibility of, instead of a bat, you have actual real just tariffs, punitive tariffs being imposed on goods coming into the United States. There might be an opportunity for them to revisit that policy.
That's a great point. So as we go through this, I often get frustrated a little bit. I mean, this example of what we just talked about is something outside the box, I would say, that's outside of the TCJA. But on both parties, I am concerned that, they have their blinders on and are only focused on what was in the TCJA and sunsetting provisions for purposes of tax reform. Are there any other items that you've been hearing whispers or discussion about in DC that would help, obviously, bring in federal tax revenue, but wouldn't necessarily have to be a checkbox of yes or no to something that's expiring in the TCJA Act?
Well, so there's a lot of provisions, for instance, in the Inflation Reduction Act, the battery credits, the EV credits, that, by all accounts are costing the Treasury significantly more than what was originally estimated at the time. I don't know where the reality lies, but it does seem like there's definitely hundreds of billions of dollars of these potential credits out there. I think if Republicans run things, they'll definitely be looking at those as offsets to extending the TCJA provisions. As I said, some sort of a carbon tax seems to have reasonable levels of bipartisan support. Certainly, I think more on the Democrat side than the Republican side. but there are Republicans who think it would be good policy. And frankly, depending on what you're using the revenues to offset with, right, it might be something that you could get a majority in the House and the Senate. Beyond that, you mentioned, sort of raising some of these, like the corporate rate, raising that a bit. Again, I'm not advocating for that, but that's definitely been something that's been discussed. I think there are a lot of provisions out there that are sort of on the outside looking in, and particularly if they raise revenue, they're going to get a strong looking at, because, as I said, they're going to need the revenue. They're going to need offsetting provisions if they're going to get anything done here.
Yeah, that's a great point. And I think part of the challenge of the messaging is to focus on those, right? Not necessarily, if you can get behind one and it's bringing in a significant amount of revenue, that releases some of the pressure on just looking at TCJA provisions.
Yep.
So definitely something to monitor.
Let me just make one more point, because I'm guessing that you covered this with Phil on the previous podcast, but when you look at the deficits, revenues are coming in pretty much at their historic levels. I mean, it's not like, even with the TCJA, we're still collecting revenue right around 18, 19, 20% of GDP. The challenge that we have with the deficits today is that spending has jumped dramatically. It used to be 20, 21, 22% of GDP, and now it's 25, 26% of GDP. So, when you want to look, okay, why are we running $1 trillion deficits, not just this year, but next year, 10 years from now, 20 years from now? It's because spending has kind of made a significant leap, of a magnitude leap kind of thing.
So I have two follow-up questions to that, because that's a great point. One, when you look at the CBO projections for the next 10 years and you see the revenue increase, obviously they have to assume that the TCJA will expire in 2025. The vast majority of the increase is going to fall on payroll taxes and individual income tax rate. And you almost see a little uptick, but almost flat, right, within the C corporation arena, which I think, when that boils down, it's again reiterating that a lot of the burden is going to be placed on, individuals and individuals through individual income tax and payroll taxes. And I think that, that's a very important graphic that I've shared with others is, if nothing happens, which, like you said, ideally, even if we have a broken or not a straight alignment within the parties through Congress and the president, there's still enough out there that concerns both the Democrats and Republicans that they hopefully will come together in reconciliation or agreement. There is some apprehension on my end because of the experience we've had with R&E capitalization in the past couple of years, that no one thought that would ever get to be actual law, that it would be flipped or extended. And we just haven't been able to do that. So I'm cautiously optimistic. But the second kind of question to that, which I think goes along with what if we have a Republican Senate and a Democratic House, is can you talk more about, and this is something we brought up with Phil, the ability to cut back on spending, as you suggest, if indeed this type of reform has to go through the budget reconciliation process? So maybe start with explaining the budget reconciliation process. It might be a good start for our listeners.
Sure. Yeah. So when Congress reformed the budget process back in 1974, and they created the Budget Act. And effectively what it does is it sets up a timetable in a process. And the timetable is, early in the new year, Congress is supposed to, the House and the Senate, they're supposed to put together and adopt budgets. They pass them through their respective bodies, and then they join together and come up with a unified budget for Congress. And the budget doesn't actually go to the president. It's a joint resolution, so it just stays between the House and the Senate. But the key thing for the budget is that it establishes two things. One, it establishes the pool of money that's available for the annual appropriations process. So if you're an appropriator, you want to, go out and spend money on military construction or whatever your appropriation bill is, you need to have the budget 302 A's and B's, or is the section of the code. You need those levels in order to get busy. The second thing, which is pertinent to what we're talking about, is it sets up what's called a reconciliation process. And that establishes or allows for the House and the Senate to move forward on programs that would affect mandatory spending. So Medicare, welfare programs, all the programs that spend money that are outside the appropriation process, with the exception of Social Security. Social Security is exempt from the reconciliation process. And then tax stuff, so tax policies. And so if you want to move tax policies through the Senate and you don't have 60 votes to do it, then you have to go through reconciliation. Reconciliation, I'm sorry, my dogs are waking up here. Reconciliation is going to enable you to move through the Senate tax policies, spending cuts, spending increases with a simple majority vote. And that's the beauty of it. The challenge you're going to have next year, if you have a divided Congress, is how do you get a Democrat House and a Republican Senate to agree on a particular budget process? How are you going to get them to agree on what the appropriations number is? And more importantly, how are you going to get them to agree on any sort of reconciliation process? I think it'd be really hard. Might be able to do it, but I think the odds are dramatically against it.
So do you think with a split that it's going to be easier for them to come to an agreement on tax reform above coming to an agreement on the budget reconciliation process?
Well, as I said before, I think both parties are going to be highly motivated to come together and do something next year. I just think that if they have to sit down and work out a compromise bill, you're probably looking at getting 60 votes in the Senate anyway. In other words, maybe they're going to have to go back and do a budget resolution and do it through reconciliation. But my guess is in divided government, you might end up with kind of a sense of the product before you end up with a sense of the process, if that makes sense.
Yep, that makes sense.
Yeah, that they're going to, okay, what can we do? The Democrats are going to want to extend the family tax relief. They're going to want to protect the tax credits for the exchange policies. And Republicans obviously are hopefully going to want to protect, much of the TCJA. I think for purposes of 199A, I think both sides will be in agreement on 199A up to $400,000, $500,000 worth of income. Mm-hmm. Where they'll differ is above that threshold. But I think that the bottom line is that they're going to have to compromise one way or the other. They might have to do it through reconciliation because even with a compromise package, they don't have the votes in the Senate. But my guess is if the Democrats in the Senate, Republicans in the Senate, and Democrats in the House can get together and figure this stuff out, they'll figure out a way to get 60 votes in the Senate and they won't have to go through reconciliation.
That's great insight. No, we appreciate that. As we're wrapping up, oftentimes, as I mentioned earlier, there's a thought process of what does it really mean if my company goes right to our congressional leader, in New Jersey or New York or Pennsylvania or where have you, and talk to them about our problems, even if they're tax problems, will it have any impact? So what we often have asked to us is how do we advocate, and should we even advocate, right? We have so many people with multiple hats that that just takes up more time and energy. What would your response be to them, especially looking out in the next 2 years when significant tax reform could take place?
I think that's the most important thing that people can do is talk to their representatives and to tell their story. As you know, and one of the things, like we're doing a roundtable tomorrow with Congressman Smucker up in the Lancaster, southern Pennsylvania area. And getting businesses to come to the roundtable to tell their story, to talk about how 199A affects them. There's lots of, there's about 30 million businesses out there that get 199A, but finding the ones that, are willing to tell their story and do a good job of telling the story, it's not easy, right? Mm-hmm. And so, but it's really, really important because as much as I can go up there and talk about these things, it's much less meaningful than if, a senator or representative's constituent can go in and say, I'm in your state, I'm in your district, I employ this many people, and this is what this deduction means to me, and this is why it's important. That, 10 times, 100 times more effective than anything I can do. So we really need the business community to get out there. And, there's a challenge there, which is, all these folks, they got businesses to run, right? Mm-hmm. And this, most of the time is not in their wheelhouse. It's not something they're really comfortable with. They're not necessarily attuned to like what reconciliation is or all these other things. And so there's a resistance to doing it. But the beauty of it is that, if you go and you just talk about your situation, your business, your employees, what you guys do and how this helps you, if you just stick to that first person narrative, you're going to be fine. You're not going to get, nobody knows your story better than you. And it's really, really effective. It really does resonate with policymakers. So it's very important that people do that.
And Brian, I think you nailed it on the head. I often get told, well, I don't know if I feel comfortable. I don't know enough about taxes. That's not what you're there for, right? That's why Brian and similar people are out there. But really, it's the story, right?
Yeah.
And it's the story that they care about of what's your impact in the community, are you growing, jobs, et cetera. And I think every business person can really speak to that to the extent they're active in their business. So I just stress that you don't need to get into any of code sections or how you pass the bills. You just need to tell your story and say, if my tax bill goes up by 30% next year, this is what that's going to mean.
Yeah. I'll give you just one really good. I mean, you did a great job when you testified. What was it, about a year ago or so? Mm-hmm. But earlier this year, we had a small business hearing where a small businessman from Denver came in and talked, and his business was, if you can believe it, he runs those little grocery kind of sandwich shops in office buildings.
Oh, yeah.
So office workers all go down and get their aspirin and there's, their ham and cheese at lunch and everything. Well, during COVID, all those were shut down. His businesses were literally just shut down. And the only way he survived was he was able to take the $199 deduction with the savings. And this was obviously before COVID. He started opening kiosks that didn't require any employees and were kind of open to the public, right? Mm-hmm. So those were the ones that stayed open. That was the revenue stream that kept him solvent during COVID and enabled him to kind of survive the whole pandemic. And he attributes it to the fact that, well, with $199, I was saving enough money that I could, invest in these kiosks, and that ended up being my saving grace. So just stories like that. I don't think he ever, like, aside from the small business deduction, he didn't have to cite any tax codes or anything like that. He was able just to speak very directly to, this is what it meant to me, and this is why I'm still in business, frankly.
And I've heard multiple time and again, because of that deduction, I hired more people, or we're expanding, we're investing in new technology and innovation. Like it's not, as some could perceive, people just lining their pockets, right? Yep. It's oftentimes pushing it back into the business and making a stronger business. Yep. So all great discussion. For those of you who may not know Brian, we've worked with him for the last couple of years, and he actually will be visiting Witham clients coming this September. So we're excited for him and some other members of the S Corporation Association to be introduced to Witham officially. We will be in East Brunswick on September 23rd. We're going to start around 2:00 and have followed by a little networking reception. And if you instead are in New York City, we will be in New York City the following day on September 24th. And we'll start at 11 and follow up with lunch. And again, just to get more and more of an understanding of what could be happening, hopefully having with them help making sure that the changes that could impact you, but more importantly, how you can, advocate for your business and for your district. So I want to thank Brian so much for being on the call with us today. And we look forward to working with you over the next 12 months and anticipating a lot of activity.
It's going to be busy. So thanks, man. Really appreciate you having me on.
Thank you so much. Take care.
Bye-bye.
You've been listening to Witham's Taxing Topics. Contact us with your feedback or suggestions for future podcast topics. Visit www.witham.com for additional information. Send an email to info@witham.com or follow us on Facebook, Instagram, or Twitter @WithamCPA. Thank you for listening.